Good morning, my name is Genevieve Stoll and I'm a real estate broker with Windermere Real Estate. I'm here today with Greg Anderson of Penrith Home Loans. We both work in the Seattle area, and on today's episode of Ask the Lender, Greg, I'd like to ask you, what do you use to determine the interest rate that your client is getting?
Right. So that's a common question.
Sure.
People are always wondering, how do we figure out what our interest rate is? Well, I will tell you that just like insurance, and we talked about private mortgage insurance in another episode, is that it's risk-based. So the higher your credit score is, the more you're putting down, that's going to get you the best rate. Mm-hmm. So generally, the best rates are going to go to people with high credit scores, more down. Okay.
Gotcha.
It isn't always that way. It just depends on the loan program. Mm-hmm. There are some loan programs that are very lenient for people who don't have as much down and have lower credit, where you can still get a very good competitive interest rate. That's how it is determined on our end. Mm-hmm. How it's determined in the market is actually by the sale of mortgage-backed securities. Okay, so mortgage-backed securities it's a trading vehicle where you could have an institutional investor like a pension fund or a hedge fund. They would buy mortgage-backed securities, so it's like a bond, right? So you're buying these loans and they're all packaged together, and they're going to give you a certain return. So how people are willing to pay and how much they're willing to pay for those mortgage bonds, that's going to determine what rates are doing in the market. So it's just like, say, a share of Boeing stock. It goes up and down every day, and if there's some trouble in the market, maybe those shares go down. If there's a very positive news in the economy, those shares will go up. It's the same thing with interest rates. So if the economy is struggling and investors are taking their money out of stocks, mm-hmm. then they have to put them somewhere. They generally don't put them in the backyard in a coffee can. They'll have to invest in bonds, and mortgage-backed securities can be one of those vehicles. So that's what determines the day-to-day fluctuation in interest rates.
Gotcha. So to be clear, and this is something that I didn't know until recently, and I've been in the business for a number of years, the interest rates that are available to a buyer from a lender are not determined by the Fed. Is that correct?
Yeah, so the Fed rate, when you hear, the Fed left rates unchanged, mm-hmm. or they increased rates.
Or the interest rates are not likely to go up for this year.
Right. So that basically is a different vehicle, yeah. And basically that is the rate that the Fed charges banks to borrow from them.
Right.
Okay, so is it possible that a Fed increase in their rate could result in higher interest rates? Yes, but it's just as likely that if the Fed increases, that rates stay the same. It just really depends on what the market is requiring for those securities.
Gotcha. And I mean, as you've probably heard if you pay attention to real estate news at all, interest rates are screaming low right now.
Yeah.
So what's the benefit of purchasing a home or making a move when it seems like interest rates are low and will continue to stay low?
Yeah, so 1% difference in interest rate increases your buying power by 10%. So think about that.
Yeah.
If you were in the market, say, when interest rates were 1% lower than they are today, so a couple of years ago, and you were looking at a $400,000 home, well, now if things haven't changed in your income and interest rates are 1% higher, well, you've lost 10% of that, so you're going to be well below $400,000 now. So buying at the right time with the right interest rates can really be a benefit, especially to that first-time buyer that is trying to fit in to their first home.
Right, gotcha. And it's really valuable.